Welcome back. As usual, let me give you the bottom line up front. Your successful retirement is pretty simple. Save 10% of your paycheck. Know that the markets have returned 10% on average. Start aggressive, dial that back as you age. Work with your financial planner to solve for things like catch-up savings, retirement date, taxes, healthcare, estate planning. By and large, this is timeless wisdom, just like eating your veggies. Every once in a great while, something will happen in the markets that requires more expertise, but it's the exception rather than the rule. We did have some volatility this quarter with geopolitical events feeling a bit like Groundhog Day, so let's talk about that first. I have two charts that will help put exogenous shocks like this into perspective. The bottom line is that we are at war in Iran, and that should give you pause. But if we look back at history, we recognize that these types of events have a tendency to be short-lived. And this first chart is from our friends at Dimensional Funds and shows geopolitical events over top of performance of global stock markets going back to 1970. And as you can see, the clear takeaway is that markets have remained strong even in the face of what felt like major events at the time. This next chart is from our friends at the Hartford and tells the same story. With each event, we can see the magnitude of the sell-off and the subsequent time to recovery. And with only a couple of exceptions, primarily the Arab-Israeli War of 1973, did the market not bounce back within the next quarter? So, and kudos to all of our clients out there, this becomes the question of whether or not this is a buying opportunity. And I love that this is the most common question I got this quarter because it means you all are thinking like professional investors. So pat yourself on the back. Surprisingly, despite what clearly seems like brinksmanship on the part of global leaders, the US markets were only down 4% this quarter, and international markets were down less than 1%. We've been advising patience. Jack Howe coined this buy the dip-itis in this week's Barron's. Jack is one of my favorite authors, and let's take a listen to what he had to say.
I want to talk on this episode about what I call buy the dip-itis, and I want to give a look at just how expensive the U.S. stock market is, where we stand, because I think there are a handful of distortions right now. I think the stock market is actually considerably more expensive than it looks, and I'll explain why. Let me start you off with some numbers. The reason the stock market has been wobbling this year, there are two key reasons. One is what I'll call artificial intelligence angst. Companies are spending all this money, and investors are worried about whether the spending is wise and whether it's sustainable, and we'll come to that. And the other one is a crude oil spike. That's related, of course, to the war in Iran. And the latest bounce back we've had at the time of this recording, that's related to maybe investors' perception that the war in Iran might wind down sometime soon. But it's a situation that's very much in flux. But in the backdrop of all this has been really an excellent trend for U.S. company earnings. If you look at the S&P 500 index, the earnings estimate for this year, it's been rising. The latest number implies a growth rate this year of 17%. That's much higher than usual. And so the result, if you have an S&P 500 that dipped a little bit in price, and you have earnings growth that's excellent going forward, you have a stock market that was recently trading at a price-to-earnings ratio, a forward price-to-earnings ratio. In other words, using estimates for the year ahead starting now. It was recently about 20, and that's down from over 23 last fall, and it's merely a 20% premium to the market's two-decade average. I say merely. 20% is, a decent-sized premium, but it's not wacky. I think you have to be careful with that math, however. investors should beware by the dipitis. That's what I call a condition that can lead to novice and even experienced investors who've been treated to these wonderful returns over the past decade and who have not seen a bear market that took longer than a year to recover since the one that ended March 2009. It can cause them to pile on risk whenever the stock market hiccups, like recently. As I'm going to explain, there are reasons to believe that the stock market is really more than 35% pricier than usual, maybe significantly more. There's a confluence of factors that have puffed up profits and flattered comparisons, and I'm going to run through three. None of these, I'll tell you up front, are deal breakers, and this is not a call to flee stocks. I just want investors to recalibrate their expectations and maybe bolster their resilience.
Jack gives 3 reasons investors might be well suited to be patient here. Primarily, stocks are expensive relative to earnings and even more expensive relative to free cash flows. Corporate profit margins are historically high, and I'll touch on that. And then lastly, we've been playing a game of kick the can down the road for decades with successive government bailouts, each of which has added to our mounting federal debt. And that bill is eventually going to come due. Let's touch on each of these in turn. The first is valuations. And as you can see here from this chart, the price to earnings ratio is 19.7. That compares to a historical average of 17 times. Another measure of value in the table shows the cyclically adjusted price to earnings ratio, or CAPE ratio, developed by Nobel Prize winning economist and Yale professor Dr. Robert Shiller. The CAPE ratio looks back at historical earnings and asks, are we paying too much for stocks based on what companies have earned over a full economic cycle, not just a good year? And at 37.2 versus a historical average of 28, stocks are meaningfully more expensive by that measure. Next, let's look at profit margins, which you can see on the right-hand side of this slide. Here we have a graph showing profit margins of companies in the S&P 500 going back to 2002. Over that time, they've risen from 8% to now 14%. And this in turn creates more uncertainty around future earnings. Recessions are a natural part of the ebb and flow of capitalism. And we've only experienced 2 recessions in the last 20 years. And those are the gray shaded regions that you can see here. The great financial crisis in 07-08, and then briefly with COVID. When the next one comes, corporate America is likely to feel the pinch. One of the challenges is that we've been managing the economy with deficit spending, effectively delaying the natural order of things. This slide shows the accumulation of that debt on the bottom right-hand side. And this doesn't even include the promises we've made to ourselves, like Social Security and Medicare. So we are the world's largest economy, and we print the world's reserve currency for the time being. So we can play this game longer than most, but eventually this bill comes due. And that's a drag on future economic growth in the way of higher taxes or lower spending. I want to give a shout out to one of our clients this quarter. I really appreciate getting feedback. Chris asked me to comment on a recent article published in Fortune magazine. You can see the title here. Scott Galloway wants the stock market to crash. Gen Z is already betting like it will. The article was based on an interview Scott did with his podcast last month at South by Southwest. Let's hear what he has to say.
Down. I personally, I never want to see the markets go down, but the 2 worst indices in history are the Dow and the NASDAQ, because they create this false comfort that we're doing okay when they go up. The Dow and the NASDAQ are effectively a proxy for how the rich are doing. And spoiler alert, they're doing really well. But I think we could see a pretty dramatic drawdown in the markets, but I personally think there'd be an upside to that. And that is, and this has been my big rant for the last 2 years. You are meant to have exogenous shocks. That's a natural part of the economic cycle. And it's healthy. War, famine, economic shocks do have a healthy part of the cycle. And what is it? Capital gets destroyed. The guy that owns the factory, the older person, loses a lot of their wealth, and advantage cedes back to labor who you need to rebuild the factory, right? These exogenous shocks are typically a recalibration. Housing prices crash. They're a recalibration or a retransfer back of wealth from owners to earners. But for the last 40 years, what we've decided is whether it's a virus or a financial crisis, rather than let assets collapse and take money from the owners and give advantage back to the earners, we're going to pull out your credit card and ensure in the form of debt and stimulus that I stay rich. So a certain amount, quite frankly, the people in this audience, it looks pretty young, you want the Dow probably to go down 30%. Because if you're going into your earning years, you want to buy real estate and stocks for as little as possible. The reason I'm economically secure is because in 2008, they bailed out the banks, but they did let the markets collapse. And I got to buy Apple, Amazon, and Netflix for $8, $10, and $12 a share, respectively. Like, where do you find value right now? So I hate to say I want the markets to go down, but at some point we have to stop propping up the markets with young people's credit cards. A certain amount of disruption and drawdowns in the market is a healthy thing that transfers and seeds power, leverage, and capital back from owners to earners.
So I'm not going to touch on the political nature of his remarks, but Mr. Galloway makes some good comments about the markets. It's been nearly 20 years since we've seen a sustained sell-off that resets the table, so to speak. Historically, those major adjustments happen every 20 or 30 years, and investors are wise not to lose sight of that. So as always, I'm going to leave you with some perspective. This chart shows typical intra-year peak-to-trough pullbacks for the S&P 500, dating back to the early 80s. In any given year, the average pullback is about 14%. And in midterm election years, that average pullback is 18%. So I'm hopeful that this gives some perspective to this quarter's returns that were down between 1% and 4%. And then lastly, I'm going to leave you with a clip from one of my favorites, Warren Buffett, who looks at this bit of volatility through a lens of over 60 years worth of investing experience. But before I share that, let me say thank you for your time and tuning in. Please send your questions my way. We are here to simplify your financial future.
It's come down substantially.
Not substantially.
Well, you've got both the Dow and the Nasdaq in correction territory. It's the worst performance on a quarterly basis for stocks in about 4 years. Do things look cheaper to you?
No. If you look at the markets of, the worst probably was the 2007-8 period, although there was that one Monday when you had 21% in a day. I mean, this is nothing.